Good morning, everybody, and welcome to our latest live webinar, Should We Be Going Nuts for QNUPS? I'm going to hand you over to Andy now, who will start the presentation. Thank you.
Right, I do apologise. I think I have just been on mute there for 2 minutes. So if the oh, brilliant, that's great, thank you. I do apologise for that. I've just been speaking for about 2 minutes to myself, which kind of reflects my home life to an extent. But hopefully everybody now can hear me. So I'll just repeat the introduction. My name's Andy Woods. I'm a tax advisor and I'm a practicing barrister. I founded ETC Tax many years ago. I'm now a consultant and they've asked me to, I guess, step in and provide this webinar, which is entitled Should We Go Nuts for QNUPS, and appropriately has a cracked walnut as the image. So let's kick on with this. I think we've done that bit. So yeah, it's worth just explaining. I mean, I've been involved in I guess pensions and investments and QNUPS for many years now. When I was in practice, I worked in the Big Four, and when I started, if you worked in private client tax, you also ended up doing some time, as it were, in wealth management as well. So I ended up doing various wealth management exams as well as tax exams. So as you can gather, for many years after that, if anything remotely pension or investment related came into the firm, it ended up on my desk. So that's where my introduction to QNUPS began. And over the years, I have advised, whether it's QNUPS or whether it's QROPS, from two different angles. Firstly, advising, I guess, prospective and existing members of QNUPS generally about whether somebody should set up a QNUPS or not, providing the tax advice there. And I guess the other stream when it comes to international pensions, I've also been fortunate enough to have clients, so large overseas service providers, and I've advised them on setting up, establishing both QROPS and QNUPS. Just to let you know, this session is very much focused on the former, so advising prospective and existing members of QNUPS. We're not going to talk about setting them up, because that's probably advice which a very particular type of client will want. I think as well, if you are advising potential members of QNUPS, so you have a client who might be interested in setting one up, you really should be able to go along to a provider and have a legitimate expectation that if they say, or they're offering a QNUPS, that that pension scheme qualifies. I'm not saying it's not helpful to be able to check that yourself. And I don't know whether Sarah mentioned it, but there are going to be some notes circulated after this session. And one of the features of those notes, that in the appendix, I will set out the qualifying conditions and requirements for a QNUPS, amongst other things, so you can have a look through those at your leisure. That's if you can't find anything better to do with your leisure time. Okay, so that's worked. I'm also finding the slides a little bit unresponsive, hence why there's been some odd slide changes so far, but that's the right slide. We've got the anatomy of a registered pension scheme on there. And I think it's worth us first of all kicking off this session by looking at the features of a UK registered pension scheme. I'm sure, and I'm not entirely sure actually, to be honest, exactly who is in the audience. I'm assuming rightly or wrongly that it's sort of, I guess, general sort of practice accountants, maybe a few sort of tax advisors and lawyers in there, but I suspect a number of you will have at least some familiarity with registered pension schemes. I think it's worth restating the position of UK schemes or registered pension schemes, because then we can look at where a QNUPS is similar and where, I guess, the QNUPS diverges from that position. And I think that then obviously leads on to where and when a QNUPS might be useful or attractive to a client. But if we look at, very quickly, just have a look at the diagram on the screen. At a high level, a registered pension scheme really is a tax efficient bucket that provides tax relief going into the scheme as the pension pot is built. Secondly, it provides tax relief on most investments, whether the investment return is income or capital. But then, coming out the right-hand arrow on the diagram, the majority of benefits taken during the member's life are subject to income tax. So really here, a pension scheme is a deferral mechanism because, ultimately those funds are being built up to be paid either to the member during their lifetime or potentially via death benefits if they don't get into a position to take them. The government, though, tends to be very careful if it's doling out attractive reliefs, and I think if you were to argue that the relief isn't quite as good as it used to be, I think you'd have a fair point. But we still find registered pension schemes are subject to a legislative straight jacket. So, and that comes in, I guess, in three main prongs: the level of contributions that can actually qualify for tax relief. They're moderated firstly by making sure you've got the relevant earnings to frank the tax relief, but also more recently a fairly sort of spicy annual allowance, which is particularly for, I guess, additional rate taxpayers and some higher rate taxpayers who are sort of in that above 100k bracket. The annual allowance takes away what was given with the other hand. Previously, we've had the lifetime allowance, which is capped. The total value of benefits that can benefit from tax relief, that has been abolished, but still does have some impact on tax-free cash levels. And also, finally, although in theory, a registered pension scheme can invest in whatever it likes, certain types of investment are subject to such a penal tax charge that for all intents and purposes, you wouldn't want to invest in those. So let's have a look at these issues for registered pension schemes in a bit more detail. So let's look at first on that wheel around contributions. So unless someone is contributing to the pension scheme, then obviously the benefits that accrue would be rather small, and usually it's going to be swelled by contributions from either an employer and or an employee. It is possible in some cases, if you can find a generous other third party, they are able to contribute, but for obvious reasons, that tends to be a bit rarer. In terms of personal contributions, then the amount of tax relief depends on your income. If you're a basic rate taxpayer, you get basic rate tax relief, so 20% essentially. If you're a high rate taxpayer, you get high rate relief, and also if you're an additional rate taxpayer, you get 45% tax relief on contributions. However, in the case, certainly of the last category, and probably those higher earnings in the middle category, the annual allowance has now been set up such that it's got plenty to say about whether you do get that marginal relief. And generally speaking, if you're an additional rate taxpayer, you're not going to be seeing a great deal of tax relief on contributions. In order to obtain tax relief as well, it's worth, I guess, in reinforcing that contributions to a pension scheme generally must be made in money. For many years, people were making contributions in species. So property was quite popular, and HMRC's manuals, I guess, perhaps unwittingly managed to, I guess, confirm to potential taxpayers and administrators that that was acceptable. But recent cases and SIP Choice and Killick have, I guess, controversially confirmed that other than in very specific scenarios, the contribution has to be in money. And also for anybody out there who is interested in crypto, then crypto is not money, and therefore you can't get tax relief on a contribution. It doesn't mean that property and crypto can't be contributed to a pension and become assets of the scheme. It just means that you can't get tax relief on those as contributions. So moving on to investments, as I said earlier, technically it can own pretty much what it likes, but the concept of taxable property dilutes that freedom significantly, and probably the main two effective prohibitions, because if you do invest in them, you'll pay a filthy tax charge. The two main categories of taxable property are tangible, movable property. So things like art, wine, and jewellery are not really appropriate to hold within a pension scheme. And probably the one that most people are familiar with most direct and indirect interest in residential property will also be taxable property. Now, I say most because there are some exceptions. So, for instance, if I was to purchase through my pension scheme shares in a home builder like Barratt's or Taylor Wimpey, then I'm allowed to hold those because there is a essentially trading exemption there, as long as it's not your own property trading company. And also one around genuinely diverse commercial vehicles, which, broadly speaking, are more like sort of, again, arm's length collective investment type vehicles. So you can invest in those as well. But if you want to buy a couple of flats in an apartment block in Manchester, then a registered pension scheme is not appropriate at all, unless you like paying penal tax charges, that is. Most people don't. So if we look at the income, so now the income, I guess, which is produced from any of those investments, there is, again, most people will be familiar, there's a statutory exemption which applies to income derived from investments held for the purposes of a pension scheme. There's not much more to say about that. There are some slight nuances that exemption doesn't apply if the trustees are trading. Again, they will be subject to tax if they have trading income. Also, and it's a slightly peculiar point, is that the exemption doesn't apply if the trustee is a member of a property investment LLP. It's slightly curious, and it only applies to LLPs. So other partnership entities are not within that sort of caveat, which, as I say, it's a slightly puzzling one. Similarly, for capital gains tax, there's a statutory exemption there. The same exclusion around property investment LLP applies too, however. Inheritance tax isn't on there as a separate category. I think for pension schemes, inheritance tax needs to be considered with death benefits, really. But a pension fund generally is going to be outside of UK inheritance tax. But as I say, income tax may well be paid on death benefits depending on the circumstances. Looking at when we get to draw benefits, usually you cannot take benefits from a pension scheme until you reach normal retirement age. That at the moment is 55, but from April 2028, that will become 57. And really, you can take up to a maximum of 25% of the fund as tax-free cash, but that is capped at 25% of the current lifetime allowance. So although the lifetime allowance was abolished for general purposes, it's still relevant for calculating the tax-free cash that a member can take from their scheme. So at the moment, the lifetime allowance is a tick over $1 million. I think it's 1.073 million, something like that, which means the maximum tax-free lump sum you can take is just over 268,000. I don't think there are many better opportunities for the government to impose a stealth tax than fiddling with what most people will see as a redundant lifetime allowance going forward. So if they reduce the lifetime allowance, which will have no general application, it will start reducing the amount of tax-free cash people can take. So that might be a little tax rise through the back door. Over and above that, benefits need to be taken as income. That income can be taken over the remainder of a member's life, or you can take it, of course, in one fell swoop these days. as you will recall, that sort of ability to take it in one fell swoop is as a result of those much vaunted pension freedoms. If anybody remembers, back to, I think it was 2014, so Christ, nearly 10 years ago now, and Steve Webb's, he was a pension minister, his famous comments about you're cracking open your pension like a coconut and going out and buying a Lamborghini. But regardless of whether you take it, you drip feed it out over many, many years, or whether you take it in one fell swoop, then it will be taxed at your marginal rate. So finally, and then we'll move on to QNUPS themselves. Let's look at death benefits. Death benefits have been, I think, in the news over the last 12 months. I think it was at the Institute for Fiscal Studies of claimed death benefits are a bit of a loophole. So I can see it being something that the government amend relatively soon. But as we've said, at the moment, if you've got assets in a registered pension scheme, it's outside of inheritance tax. However, that's not the end of the story. We need to consider income tax on death as well, because if funds are paid to a beneficiary, then they may be subject to income tax. And again, rather arbitrarily, the tax treatment depends on whether the pension member died before they got to 75 or whether they died afterwards. And it is a cliff edge, a fairly strange state of affairs. But if you die before age 75, then the benefits can be paid as a lump sum or as a drawdown pension to any beneficiary free of tax. However, if you make it to 75 and beyond, then if you draw down the benefits as a pension income or as a lump sum, then the beneficiary is taxed at their marginal rate. Alternatively, you could have the funds paid, say, to a trust, a family trust, and that would be subject to a 45% charge. So not easy advice to give to a client, but they need to plan their death rather carefully. So that was registered pension schemes. As I say, it's useful groundwork because we can discuss how a QNUPS diverges from that position. But a little bit of preamble, I guess, not ramble, I hope, preamble. But the legislation, let's first look at the legislation around QNUPS. I think it's worth pointing out that a QNUPS isn't it's not a self-contained product, although there are plenty of products out there designed so they fall within the QNUPS rules. Now, I'm not trying to be profound here. It's because, quite simply, QNUPS is just a specific tax status. It's simply a section in the tax code like any other. And the QNUPS provision is nestled towards the end of the Inheritance Tax Act. But that said, the provision, so the statutory provision, doesn't really do anything other than act as a signpost to secondary legislation, so to key statutory instruments, really. And it's those statutory instruments that add meat to the fairly thin statutory bones provided in the Inheritance Tax Act. But breaking it down even more, and QNUPS really is just a type of international pension scheme. But it is importantly an international pension scheme that, I guess, doffs its cap enough to the UK pension system and the UK tax system such that HMRC is prepared to recognise it. And if my camera was on, I'd be doing the little sort of quotation marks around recognise. But HMRC will recognise it for tax purposes. Now, again, just so we're not getting confused with similar terminology, and sorry if I'm teaching you to suck eggs, but recognised is not the same as being registered for pension schemes. So all the stuff we've just been talking about, that applies to UK registered pension schemes. QNUPS, QROPS, by definition, will not be registered, but the secondary status of being recognised is important. So, as I said in the notes that you'll get after this session in the appendix, I'm setting out essentially the building blocks of how schemes qualify as either being a QNUPS or a QROPS. Those building blocks will be in the appendix of the notes whether we're going to send around later, but I don't propose going into them today because I don't think, generally speaking, it's something that most people are going to come into contact with, if at all, really. So the second point on there, a QNUPS is not a QROPS. Now, most of the letters are the same, but for the acronymically challenged, let's state it once again, a QNUPS is not a QROPS. And as I say, the detailed differences between the two, I don't really want to go into today. And in many ways, they do share the same DNA. So, for instance, both are going to be recognised overseas pension schemes, or ROPs. Now, it's really at that, beyond that point, that the two diverge. So, a QROPS is a ROPS. And it is awarded, I guess, a special Q because the people managing it, the provider of the pension scheme, promise essentially to report to HMRC around particular issues. So things like they will report payments to members for a certain time to HMRC, and because they promise to be good boys and girls to HMRC, they basically have on them bestowed the special honour, really, of being able to receive the contents of a tax-relieved UK pension pot without it being an unauthorised payment. So if I transfer my SIP just to an overseas trust, then that will be an unauthorised payment. That's not I guess, an authorised payment. It's not a recognised transfer, so I would pay tax there. But if we have a registered pension scheme paying or making a transfer to a QROPS, then that is not an unauthorised payment. It's a recognised transfer. It's specifically allowed. And this is a key difference between a QROPS and a QNUPS. A QNUPS cannot, unless it's also a QROPS, it cannot take money from registered pension schemes. Now, just with a little bit of an aside, when it comes to QROPS, now an RPS, so a registered pension scheme transfer to a QROPS, was fine. It was a recognised transfer, and up until 5 or 6 years ago, so I think Finance Act 2017, that really was the end of the story. But once again, not being able to leave the legislation alone for 5 minutes, the government decided to introduce something called an overseas transfer charge as well. And this charge, you consider after the fact you've already determined that it's a recognised transfer. So the overseas transfer charge can apply to a registered pension scheme to QROPS transfer. And you will only avoid that charge, and I use avoid in an unloaded sense with a small a rather than a capital A, you will avoid that 25% charge only in two scenarios. And the first is if the member and the QNUPS are in the same jurisdiction. So if you've emigrated to Canada and you transfer your scheme, your registered pension scheme, to a Canadian-based QNUPS, then that is fine. Alternatively, the QNUPS needs to be established in an EEA member state. So there's no issue with me being a UK resident and transferring my SIP to a QNUPS. But if I want to avoid that relatively recent invention, the overseas transfer charge, my QNUPS would have to be in an EEA member state. So, for instance, if I think it's an EEA state or an EU member state. So somewhere like Malta, for instance, is quite popular for QNUPS. Other than that, though, so if I move to Canada and I try and move it to the Maltese QNUPS, the overseas transfer charge will apply. If I stay in the UK and I try and move it to a QNUPS in, let's say, Gibraltar, then the overseas transfer charge should apply, because I don't think Gib is in the EEA. So where were we? Yeah, so I guess just if there's one thing to take away from today is that a QNUPS is not a QNUPS, so don't try and transfer any funds from a UK registered pension scheme to a QNUPS because you will encounter a lot of tax issues. So we've got a very similar diagram as we shared earlier for registered pension schemes. This is rather an anatomy of a RPS, it's an anatomy of a QNUP. So again, really, for me, I'm quite, I find pictures help. I'm obviously a simple soul, but it's easy to think about what issues we need to consider with money going in. What do we need to think about in terms of the ongoing position of the QNUPs? So making investments, receiving return, etc., etc. And then also, what do we need to think about when benefits ultimately come out and are paid to beneficiaries? So, like registered pension scheme, I think maybe the proportion isn't quite as high. I think for a registered pension scheme, 99% probably written under trust. The other 1% may be written under contractual arrangement. QNUPs, again, I guess the substantial majority of QNUPs, I think, is still written under trustee, but there are probably more, a bigger proportion for RPSs will be under contract. And the reason why that might be attractive is that it might be helpful when it comes to applying the principles around disregarded income for non-UK residents, and we can perhaps discuss that a little bit in a moment. So let's go through these one by one, like we did with the RPS again, just so we can compare and contrast, because I think that's helpful. And I'm only going to really consider here, there's a bit more discussion, I think, in the notes, but I'm going to really just talk here about an individual making contributions and not contributions made by an employer. Now, that's not just me being lazy. I am quite lazy, but I'm not guilty this time. And the reason why I focus on individuals is it would be quite unusual for an employer to contribute to QNUPs. And the reason behind that is that if we'd have to be careful from a tax point of view, because we'd first of all need to consider whether if an employer makes a contribution, so let's start using some terminology that might lead us down the right path. But if the employer was to finance that QNUPS, then we would need to think about the rules that relate to EFIRBs, so employer finance retirement benefit schemes, which tend not to be particularly benevolent in the UK tax code. So we wouldn't really want it to be an EFIRBs, all things being equal. The second point is whether, if we have an employer contributing funds into the QNUPS, so to a third party, how would the disguised remuneration rules, so Part 7A of ITEPA, all those rules that were brought in to combat EBTs, pumping out disguised loans to contractors, how would those rules apply in these circumstances? So they need to be thought about very, very carefully if you have an employer involved. There's more discussion of those points in the notes, but I don't really want to get bogged down in that today just because of time. But let's return to my premise that it's an individual making contributions. Now, there'll be no income tax relief on those contributions, so forget about that. However, the other side of that coin is that the contribution will also be outside of an individual's annual allowance, so they won't be tested against the annual allowance at all. So if you've got somebody, let's say they're an additional rate taxpayer, perhaps even somebody on bigger books, but they're in the higher rates band only, they're probably not really missing out on anything there. So as a potential use, a potential use of the QNUPS, then it can act as a useful, I think what used to be called in old terminology, a top hat pension scheme. So if maximum relief has been mopped up for a particular year, then you might want to consider making additional contributions to the QNUPS. And I think, in my experience in this area, if you've got entrepreneurial clients, they tend not necessarily to like being in that sort of straitjacket investment-wise that you can have with a registered pension scheme, whether that's to do with things like not being able to invest in residential property, restrictions around unquoted shares and investments and sponsoring employers and employer loans and all those kind of things, which are tightly regulated by a registered pension scheme. Actually, an entrepreneurial client might be happy to forego any tax relief which is available anyway, if they've got a greater range of investment flexibility under the QNUPS, and we'll come to that in a minute. But that might be a price worth paying for your average control freak of an entrepreneurial client. Assuming that your contribution in cash, then really there aren't going to be too many other issues associated. So, for instance, capital gains tax or SDLT implication, anything like that. Clearly, those will be highly pertinent where you are contributing assets into a QNUPS. The IHT analysis, it can be quite circuitous, but the position that I've got and comfortable with now is that as long as your contribution to the QNUPS is being made to secure genuine retirement benefits, then there shouldn't be any inheritance tax consequence of the contribution. So it shouldn't be a transfer of value for inheritance tax purposes. And I think broadly that this is a result of the fact that if you put in, I don't know, let's say you put in £100,000 into the QNUPS and you are receiving £100,000 worth of retirement benefits in return via the QNUPS, and there's been no diminution in value of your estate at all, because remember, that is how you calculate, generally speaking, inheritance tax charge. It's always on a loss to donor principle. So if I exchange £100,000 in cold hard cash for £100,000 of valuable pension rights, then there is no reduction in my estate. And I think there are other ways, actually, if you navigate your course through the Inheritance Tax Act, how you can get to an analysis where there is no inheritance tax on the contribution. But again, it revolves around the fact that it needs to be set up to provide genuine retirement benefits. So in order, I think, to demonstrate the fact that they're enhancing their retirement provision, I'd advise it on a couple of points. First of all, I think you want some advice supporting the level of contribution. Now, I think technically that probably should be provided by an actuary, but yeah, I can see circumstances where perhaps an experienced IFA or other professional might provide that, but some kind of advice supporting the level of contribution. So things like it to support their lifestyle and things like that. And I think it's also worth making sure that there is a statement accompanying any application, and also subsequent contributions that they're confirming that they're in reasonable health as well, so they're not you don't want to really excuse me, well, it's making large contributions when they've just been diagnosed as use an extreme example with 6 months to live again. That's suspiciously looks like it's probably not to provide retirement benefits, it's to provide an IHT benefit. Excuse me. So income tax, as I said, no income tax relief for the member. Capital gains tax on the contribution, yeah, as I said, cash is fine. If the scheme accepts contribution in specie, then it might trigger a CGT liability if it's a chargeable asset and it is standing at a gain. Well, I mentioned previously the annual allowance won't apply to a QNUPS because the annual allowance only applies to registered pension schemes. It was the same with the lifetime allowance before it was largely abolished, that it didn't apply to a QNUPS. If we come to the types of investments that a QNUPS might invest in, then I think this is potentially where the attractions, I guess, gestate for a QNUPS. There is no prohibition, either legislative or practical, excuse me, on a QNUPS investing either directly in residential property, gold bullion, art, fine wines, etc. Yeah, it has to be subject to the provider permitting it, the scheme rules permitting it, but there's no statutory prohibition. There's no tax penalty. There's no concept of taxable property here. If we move on to inheritance tax, again, as I said before, the definition, also the acronym QNUPS comes from the IHT Act. And broadly speaking, if value is comprising a QNUPS, then it is exempt from IHT. Importantly, an interest in a QNUPS will not be relevant property either, and that means that it's immune from the 10-year charge and also the exit charge. If we look at how investment return is treated within the QNUPS, then firstly, capital gains tax. There's no special specific QNUPS CGT exemption, but then we don't need one. QNUPS doesn't need its own specific exemption because if we look back at the exemption which applies to registered pension schemes, we might see something that is a pleasant surprise. So in the Capital Gains Tax Act 2711A, a gain accruing to a person on the disposal of investments held for the purposes of a registered pension scheme or an overseas pension scheme is not a chargeable gain. A QNUPS will almost always be an OPS. I'm not seeing a scenario yet where it isn't. So the disposal of assets by QNUPS trustees should be free of UK CGT. There's that caveat around property investment LLPs again, so just be careful of that. But again, importantly, non-resident capital gains tax doesn't apply to a QNUPS either, because when they introduced non-resident capital gains tax, it was in two tranches, if you remember, in 2015 and 2019, and now all indirect. So the jurisdiction of UK capital gains tax for non-residents now includes both indirect and direct interests in residential and commercial property. Now, that extension of the jurisdiction does not affect the QNUPS because the specific exemption which applies here to overseas pension schemes trumps the non-resident capital gains tax rules, and that's fairly clear. Income tax, we don't have the same benefit for income tax purposes, perhaps oddly, but maybe when you think about it, more reflective of how the jurisdictional base of CGT and income tax differ. So if we look at the relevant section, the income tax exemption applies to income derived from investments held for the purpose of a registered pension scheme. There is no and there is no, so it's not extended to overseas pension schemes. So we find ourselves at the mercy of the normal income tax rules as they apply to non-residents. So in summary, UK income is potentially within scope under basic principles. Foreign income, absent any of the anti-avoidance rules which might apply, are not within the scope of UK income tax because we've got essentially a non-resident recipient. Now, some of you may be familiar with the concept of disregarded income, which means that in some cases, that general principle that even a non-resident will pay UK income tax on UK income, that is disapplied. So I guess most famously, if you have somebody who has a UK company, and notwithstanding any temporary non-residence rules or anything like that, if they go and live in Monaco, for instance, and they take big fat dividends from their UK company, then that is disregarded income for income tax purposes and not subject to UK income tax. So we might be thinking, well, actually, that kind of principle, we could take advantage of that through QNUPS. Well, sadly, we can't, because disregarded income, I guess, is an exception to the general rule, but this is UK tax, and we have exceptions to the exceptions, don't we? So, and there is one here that broadly, where we have non-UK trustees and they receive income which would ordinarily be disregarded income, so the dividends, say, from the UK company, if there is a UK resident beneficiary or potential beneficiary of that trust, then we cannot benefit from those disregarded income principles. And I think, again, if your clients are UK residents, as a UK resident member of that pension scheme, then we are not going to be able to benefit from disregarded income. Now, if you remember, I very briefly referred to contract-based QNUPS. Now, a contract-based QNUPS would not have the same problem because it's only non-UK trustees which are subject to that exception to the exception. So that might be a reason why a client might look at structuring their QNUPS as a contract-based scheme. But if we do have UK income within the trust, well, this is where QNUPS aren't very efficient. So we've seen potentially for capital gains tax, they can be very, very attractive. For income tax purposes, they're not, because QNUPS will be in the rate applicable to trust because it will have the power to accumulate, so like a discretionary trust, which means the rate applicable to trust applies. So other than a very small allowance, all of the UK income will be subject to 45%. But as I say, only UK income within the trust. So again, you might, even where you want the underlying investments to be in the UK, you might look at trying to wrap any UK income producing property in some kind of structure, even if it's just holding it through an intermediary non-UK company or something like that, so that the trustees are receiving dividends from a non-UK company. But that will clearly depend on a case-by-case basis. So moving on to drawing benefits. Now, there was in Finance Act 2017, there was an attempt to align both benefits payable in life and death benefits for non-UK schemes with UK registered pension schemes. And largely that has been achieved. So if you look at somebody who's drawing benefits in their life, then they take it as a pension income. And they, generally speaking, the local jurisdiction will not let them take it before they've reached age 55. Otherwise, it wouldn't qualify as a QNUP. So it has to broadly reflect the UK system. But once they get to 55, if they take a pension income, subject to income tax in full. There's none of that. You remember the 90% nonsense? Only 90% of a foreign pension was taxed. Again, a very curious relic, but that has been scrapped as well, such that 100% of the income is taxable. A lump sum paid under a QNUPS is also fully subject to tax. So, but that's at the first step. So the first step is when you're calculating how a lump sum is taxed, you bring it all into charge, but then you can effectively, and it's a fairly tortuous step-by-step process, but it's essentially you can deduct from that taxable amount anything that, if it had been paid by a registered pension scheme, would not have been taxable. We can deduct that. So let's say that the individual had no registered pension schemes and just had a QNUPS. They will be able to take the 25% as a tax-free amount without it being subject to income tax. Now, it's important to note that that 25% is global, so it's across all of their other schemes, so registered pension schemes and any QNUPs that have benefited from that as well. So that's important to look at. Non-UK resident members, there's potentially some attractiveness there. Generally speaking, the OECD model convention will provide that pensions are only taxable in the country in which they reside. So if there's a model agreement between the UK and, say, let's say, I think even somewhere like Dubai, for instance, has the model convention that if you take an income from your UK SIP and it's paid or any other pension into Dubai, then the UK won't seek to tax either of those, and it will just be taxed in the local jurisdiction. Yeah, obviously somewhere like Dubai, then that's free of tax. Death benefits, again, largely similar to benefits in lifetime. We still have that cliff edge between dying pre-75 and post-75. If the scheme member wasn't resident in the UK prior to death, then the benefits shouldn't be taxable in the hands of a non-resident individual. So we're getting close to 10 o'clock. I'm conscious that I wasted 5 minutes talking to myself on mute, and I'd just like to discuss at least one or two of the case studies. The full ones in the notes, and then maybe we have some questions then, if that's okay. I think I've probably illustrated as we've gone some of the areas where you might want to use a QNUPS, so around freedom of asset choice, using as a top hat pension, a combination of the above. I just want to do a little bit of a risk warning around inheritance tax, which with QNUPS is often the elephant loitering in the corner of the room. I think I've previously mentioned that where some kind of inheritance tax avoidance structure is clearly a plan, then the tax analysis might fall apart, and particularly some of the anti-avoidance rules might, which otherwise aren't interested in the QNUPS, might suddenly start pricking up their ears. But we also need to remember that it is a pension scheme. So the UK will treat it as a pension scheme. The local jurisdiction is treating it as a pension scheme. So at some point, somebody is going to be taking some benefits, whether it's during the lifetime of the member or following their death. Somebody's going to get something out of there. And unless it's death occurring before 75, then those benefits are going to be subject to income tax. So if the beneficiary is UK resident. So you have to be very careful that when you're setting up a QNUPS, you're not actually turning capital into income. Now, if this is a 30, 40-year play, then that's fine. But if you're looking at setting something up where potentially you're taking benefits out in 5 years, it might not look quite so attractive. So always with any tax planning, think about the end game. Just don't think about the tax attraction on setting it up and ongoing. Think about what happens at the end of the exercise. So just very simply, I'll spend a couple of minutes going through this very simple QNUPS and just looking at some of the things we've talked about in a bit more detail earlier. So here we've got Mrs. Miggins. She wants, and these are all set out in the notes, by the way. Mrs. Miggins wants to build or establish a new QNUPS. She can't, because she's an additional rate taxpayer, she can't really get any meaningful contributions into SIP because of the annual allowance these days. She also has a couple of investment objectives as well, because she wants to build a residential property portfolio through the QNUPS. She's also got a bit of crypto knocking around, and ideally she'd like to get that into the QNUPS if she can. Fortunately, we've got a very accommodating provider who not only is happy to directly hold interests in residential property, which might not always be the case, they're also happy holding crypto, which is remarkable. I would say that would be the exception rather than the rule. But anyway, I digress. So she's going to put some cash in, and that's earmarked for the trustees to build the residential portfolio. So assuming that this is to build a genuine retirement pot, then there should be no real tax consequences of transferring the cash. Remember, no tax relief going in. The trustees can take that cash and they'll just invest it like anybody else. So, for instance, if they're going out and buying residential property, they will need to be mindful of things like stamp duty, land tax. As a trustee, probably set up as a discretionary trust, then they're likely to be paying the 3% additional surcharge on every purchase. Also, let's not forget the surcharge for non-residents as well. So we're going to have to think very, very carefully about this from an SDLT point of view. But again, that not for today. If we transfer assets in, so in this scenario, I think we've got an in-specie contribution of crypto, and that's got a little red box around it, meaning, hang on a minute, this might not be so good. It will be a disposal. Now, fortunately, one way of looking at it, her crypto, it stands at a loss. So she's going to transfer them in at a loss, no capital gains tax to pay. However, always worth considering if you're transferring it to a friendly structure, they would be clogged losses. And when I say clogged losses, it means that that loss can only be offset against gains on transfers to this QNUPS in the future. She can't use it against other assets, for instance, well, other disposals, I guess. As we've seen, tax-free gains, even on the UK residential property, free of capital gains tax. However, income tax, probably pretty inefficient. UK rental property, no chance that that's disregarded income in any scenario, to be honest. That will be subject pretty much to 45% on the full shebang. Also, if it takes on any lending, it shouldn't get any, it should be subject to the restrictions on mortgage interest relief, as it is an income taxpayer. So not potentially great there. Would also be subject to non-resident landlord scheme as well. Income from the crypto would be more complex. Coincidentally, I had an article published in Taxation last week about the source of income from crypto assets, but perhaps one not for today. I've put IHT protection, but in an orange box, again, just to reflect what I described as the elephant in the room. It will sit there outside the scope of inheritance tax, but again, let's just think about what happens when it comes to retirement, when it comes to death, what's going to happen. If Mrs. Miggins or her family decided they were going to move overseas to sit on the palm in Dubai, then that would actually be quite an attractive end game. If they're going to stay in the UK, less so. I'll just take 2 more minutes, Sarah, and then we'll ask questions. And I'll probably just skip to the last one. I won't talk about it too much, but the mixed partnership here is perhaps just a structure which might solve the inefficiency around rental income from a property portfolio. Just note that the partnership in all of these cases where there is property held is not a property investment LLP, because that would turn off the tax, the CGT exemption. So that's something to bear in mind. But in this scenario here, we have the partnership holding the property portfolio. We are going to split the returns from that portfolio, such that capital gains are received by the trustees. So outside of CGT and non-resident capital gains tax, but any income from the portfolio is received by the company, and the company potentially 2 benefits there. Firstly, it will pay tax at lower rates. Secondly, it will potentially get full relief for any interest paid on mortgages. So quite an interesting structure, probably very, very difficult, not impossible, but a lot of care would need to be taken if you were doing this with an existing property portfolio, not just from a capital gains tax point of view, but from a stamp duty land tax one as well. It's worth noting, again, probably many people, if they've been around the block and working in this space for over a decade, will probably at least vaguely remember rules around mixed partnership. So scenarios where you've got partnerships with income taxpayers, so in this sense, QNUPS rather than an individual, and you've got a limited company and you're artificially diverting income to the corporate partner. So that might look at first blush that such a structure would fall fairly and squarely into this. One way to ensure that those rules don't apply is to make sure that the funding and finance of this structure comes ultimately via the limited company, because even under the mixed partnership rules, if you have the corporate partner either contributing services or cash or finance into the partnership, then it is allowed to get a return which is commensurate with that. And I think if it has provided pretty much all of the funding, then that return could be relatively helpful. So I think that I will call it a day for the main course. If we have any questions, it's worth us maybe covering those now. But just in conclusion, I've talked about QNUPS. It's not a magic bullet or indeed a magic bucket where all your tax issues will disappear. It is a tool and it does have some attractions, but also you do need to think quite carefully, as I think hopefully I've illustrated, particularly around the end game. And I would be very, very careful about approaching it purely and simply from an IHT mitigation point of view. But have we got any questions? Sarah, okay, so we've got one here.
Yes.
Is
yes.
Is it a UK company or non-UK company in the QNUPS case study? So I'm assuming we're talking about case study 4 there. It could be either. Certainly, it would be more efficient if the limited company was resident outside of the UK. Now, for corporation tax purposes, that doesn't make any difference whatsoever, because as we probably aware, that the limited company is going to be either subject to corporation tax under normal UK corporation tax rules, or if it's a foreign company, it's going to be subject to corporation tax under the non-resident landlord rules. Because if you remember, companies in respect of non-resident landlord obligations now within the UK corporation tax code. So it's not going to make any difference from a UK corporation tax point of view. So you may say, well, what's the point of all the extra rigmarole of having directors sat on a rock somewhere managing and controlling the company so it's non-resident? Well, I think the answer to that is it just means that if you want to get value up into the QNUPS, and I say if, because you might certainly be reinvesting most of the after corporation tax profits back into the portfolio. But if you want to get value up into the QNUPS, it's more efficient for the QNUPS to receive a dividend from a foreign company than it is to receive a dividend from a UK company, because if it's a dividend from a UK company, it's going to be taxable under basic principles, and unless it's a contract-based QNUPS, it's not going to be able to take advantage of the disregarded rules if it's foreign income, and the trustees simply won't be taxable on that amount. I think that answers the question.
We've got another question. It says, you mentioned case study 4 that the limited company provides the finance. How does this work in practice?
So it could be in either way. It could be cash. I mean, crudely, it could be cash from the contribution into the QNUPS. The QNUPS then invests in the company, and then the company finances essentially the LLP with, I don't know, say a capital contribution or something like that. If you're being extra careful, belts and braces, you might say to yourself, well, yeah, but ultimately, if you look all the way back, the QNUPS, so the income taxpayer, has actually provided the funding indirectly. Now, I don't think that would necessarily be a point that was taken, but you could do so. You'd have to be slightly more careful in that scenario. But it's something that, from a practical perspective, is more than possible.
I've just got a couple more before we finish. The next one is, for a good audit trail, what would be on all of your QNUPS files in terms of tax advice, etc.? And is this regardless of where the client resides?
So I would, I mean, I come from, I guess, having trained, I think, in the big four, and then I guess more latterly as a barrister, in my view, you would certainly get tax advice, which sounds which to me sounds, yeah, you would, wouldn't you? Whether that's what a tax advisor would say only, and other people might not do, but just for the avoidance of doubt, I would get tax advice. And I think, fortunately for us tax advisors, I think most CSPs out there, so whether they're forming non-resident companies or non-resident trusts, or in this case a QNUP, will require that they have a copy of tax advice for the file. So yeah, you're going to want the tax advice. The client is going to want to have it, because clearly tax advice protects them from tax penalties. And in an offshore matter, again, not getting into the detail, but an offshore matter will take penalties into the very, very spicy offshore penalty regime, which in worst case scenarios could take you into, I guess, strict liability territory. If you have got advice, again, you're going to be protected from that point of view. If you're an accountant, I guess, or other advisor who is introducing clients to QNUPS providers, again, if you don't feel that you're comfortable with providing the advice, again, make sure that you bring somebody in and you have a copy of that advice for your file as well. Actuarial calcs, yeah, I think I might have imagined it, but certainly intended to say it earlier, that I think that's important. I think clearly most of these arguments are going to be taken 5, 10, 15 years, aren't they? Down the line, and the HMRC might say, you didn't set up that for genuine retirement purposes. The client may well be dead, of course. So therefore we're going to throw an entire dossier of anti-avoidance provisions at you, etc., etc. Now, it's obviously incredibly helpful if you dust off your file and you've got a report. I think the textbook report will be from actuary, setting out, this is the kind of provision that this individual needs in their retirement. This is the shortfall from their existing pension provision, and that report will be potentially really helpful. Hopefully it's never looked at again, but having that on file will be important. And I think if you're making any substantial contributions further down the line, that would be important as well. Is that regardless of where the client resides? I think it's irrelevant to an extent. Clearly, again, if you're domiciled in the UK, even if you're living overseas, potentially inheritance tax is going to bite on you, isn't it? And one of the things that many expats forget is, they may have been living overseas for 5 to 10 years, but inheritance tax isn't primarily based on residence, it's on domicile. So if you've got a non-resident who is, I guess, although it may not have been built, the structure might not have been built for IHT purposes, it's relying on it in terms of their own IHT position, then yeah, you'd want them the same as well, would be my sort of gut instinct.
I've got 2 more questions. Are you okay to take them, Andy, or do you want to answer them offline and we'll send the answers out? What would you?
So yes, Dom, I think Mum Dom, we've answered that one.
Yeah. Who's a typical client that would benefit from this? Overseas property investors based outside the UK. There's another question.
Yeah, I think it is. I think that would be very, very much in the wheelhouse, wouldn't it? If you've got, let's say, I don't know, but it's maybe in the dangerous stereotyping here, but some Middle Eastern investor in UK residential property, it would seem quite attractive to me to use a QNUPS, so a structure held within the QNUPS, because one of the attractive things that I didn't mention is, I don't know whether I don't want to go too much into how non-doms attacked Freudian slip there, yeah, attacked through tax anyway. A common structure used to be the excluded property trust, didn't it? So people would hold, non-doms would hold their UK property through an excluded property trust. Now again, back in 2017, for an excluded property trust, if you work your way all the way down the structure, and at the very bottom there's UK bricks and mortar, and you have a beneficial interest in it, then that's subject to inheritance tax in any event. Same doesn't apply to a QNUPS, because you are not relying on the excluded property rules to get yourself out of IHT. You're relying on the QNUPS provisions. So that would be very much in the wheelhouse, yes, in a long way around to answer your question. I think that's pretty much everything, Sarah, now, actually. If everybody's happy with that, I'm quite happy if people have any other questions, email them in. I'm quite happy to answer them.
Yes, send your questions into comms@etctax.co.uk and we will get the answers for you. Please do follow us on social media and Eventbrite to find out when our next live webinars are coming. And thanks everybody for attending, and thank you so much, Andy, for giving us this presentation.
No problem.
Thanks everybody.
Okay.
Bye.
Bye.